Welcome to another edition of Requested Topics from our previous webinars. Not during the webinar, of course, but after each webinar we have a little survey there, a questionnaire. It says if you'd like to see other material, let us know. And in this one, we are going to cover unusual options activity and strategies on SPX. So let's start with segment 1. EricJ wanted to know about looking for or strategies for unusual options activity. Well, of course, we have just the criteria for you in the patented PowerOptions tools. In most of the 23 strategies we support, a couple extra, you can search by a filter called percent current option volume or percent previous option volume. The percent current option volume takes today's total option volume, all strikes and months, compared to the 30-day average option volume across all strikes and all expirations, adjusted for the time of day. So if the option volume is equal to the 30-day average, the option volume at market close, this number would be 100% current option volume. Now the previous, of course, would be the total across all strikes from yesterday's close. To use this filter, simply enter the desired values into the parameter field in any search on any strategy. Click on your desired strategy, click on the search tool, scroll down below the listed trades to access the parameter field. In the options section, scroll down to the bottom and you'll have the liquidity fields where you can enter simple views for option volume today, open interest, percent current option volume, previous option volume, and percent previous option volume as well. Here we took one of our default searches and told the system to narrow it down to only those positions that have a percent current option volume of greater than 250%. And of course, a previous option volume of greater than 90%. Well, simple enough. We run that search and we get a few results. On semiconductor, you can see in the column field here, it has a percent current option volume of 261%. We can notice also that the current option volume today on this particular option is 777, higher than the general open interest of 735. Well, this is good news for me because I'm in a married put for on semiconductor, so it looks like there's a lot of activity going on with the volume. Now, we also have TSM, Taiwan Semiconductor, and Upwork. Now, why are there only 3 results? Well, this was based on a default search containing other criteria for time frame, looking at least 75 days out in time, Bollinger Bands, of course, and other criteria as well. The results can depend on a few things. The day of the week. There's usually lesser activity maybe in the middle of the week unless some news comes out and the market's in a panic. We see a lot of activity maybe on Monday, of course, or on Friday of an expiration of a weekly series, or now on Wednesday if there's more activity for the expiration cycle of the SPY or SPX, Monday, Wednesday, and Friday, daily, near daily options expiration. There's not a lot of upcoming events or earnings, and we have more of a calm market. You might not see on a regular basis a lot of high option volume or unusual option volume, Eric, in that case. But this tool will find them. Now, I just showed how you could do it basically going into the search tool for a given strategy and adjusting the criteria manually. In many strategies, such as long calls and long puts, we have a default search to help you get started. Go into the long call or the long put, click on Sample Searches, and then you can click on Current Option Volume. It'll be available for both strategies. This is looking for long calls or long puts where the total option volume today is greater than the average 30-day total option volume for the underlying stock itself. Now, this default sample search is similar settings that we discussed, along with other criteria. We'll get to that in a moment. So it starts off looking for an option volume today of at least greater than 100 contracts, a percent current option volume of at least 150%, so about 50% more than the average over the last 30 days. Of course, we also want to see positions that were more active that had a previous option volume of at least greater than 100 as well. Our results? Well, here we have a few more. We're up to 34 results. We have a couple for Fitbit that has shown a high percent current option volume of 480%. Jumaya Technologies, don't know them. Virgin Galactic, 350% current option volume. There's our semiconductors again, and eBay even at 238%. We didn't see that in our first result because remember, we searched for a percent current option volume of greater than 250. By the way, it's always a good point to remind you that if you don't have the percent current option volume or percent previous option volume in your data field for your results in a given search, just click that Add Remove Columns button up at the top, scroll through the list, and select the available columns that you want to see for the stock or for the option to customize the table to meet your search goals. Now, I mentioned a difference in criteria. Let's take a quick look. The main difference here, these are our two searches. The first results I showed you that only had those three results with Upworks and the two semiconductors were based on the default Bollinger Band screen in the search field, looking for a percent of 52-week range of greater than 60%, a percent Bollinger Band range of greater than 95%, and stocks above the 20-day moving average. Then I added in that percent current option volume of greater than 250. That's my way why maybe eBay was taken out and others, and of course some other criteria. On the right-hand side, the sample search, you see there are no technicals being used. It's focused mainly on a percent current option volume of greater than 150, previous option volume of greater than 100, and an option volume today of greater than 100 as well. The days to expiration, implied volatility, strikes in or out of the money are similar for both screens. Difference is why we only saw 3 on the first results is because that's based on the Bollinger Band default search in the main search field for the long options, whereas the sample search, the current option volume for long calls and long puts is really not looking at any technicals such as MACD, Bollinger Bands, or simple moving average. But again, you can start from scratch, create your own search. Either will give the desired results, and of course some tips on using the percent current and the percent previous option volume. Don't go to too high of a value, 500%, 600%, 1,000%. You'll find them if you're there with the patented search tool, but remember, start off at maybe 200, maybe 150, and then move up from there if you have too many results and you just want to target the highest percent current option volume. Give the market some time in the morning. You know, there's a lot of activity usually between 9:30 to 10 o'clock, but if you're looking for the ones that are sustaining high option volume compared to the 30-day average, maybe run the search at 9:45, maybe 10 in the morning, maybe wait till noon to see more activity and a continual building of activity rather than a quick start at the beginning that fades out towards the end of the day and might not give the best results. Now, at times it might be better early in the morning to start with a search with the percent previous option volume looking for yesterday's activity, and then add the percent current option volume to pare it down a little bit. Or, of course, run a percent current option volume only early in the morning, as I mentioned, maybe at 9:45 or 10 a.m. after some activity is kicked in and it continues on. You could use that sample search we showed, current option volume, as a starting point, or use the default standard searches in the search tool for your given strategy to start, and then add in that percent current option volume or percent previous option volume as well. But Eric, that's the tool that you want to use. Most investors who are looking for the high percent option volume tend to be buying calls, buying puts, maybe buying straddles, not necessarily selling naked puts, selling naked calls, or doing covered calls with the higher volume. That just seems to be what I've run across over the years with various coaching sessions, talking to other options educators, and more. But in any strategy in PowerOptions, you'll have the ability to search for percent current option volume and percent previous option volume to meet your needs for looking for unusual option activity. All right, segment 2. Well, this is a discussion on strategies just on SPX. And this came from a comment from one of our webinar attendees that was sent in after, I believe it was the June 19th, but it might have been the June, oh, I'm sorry, it was the June 26th presentation, and it was from Faux Trader. And Faux Trader had the question of, why are there no strategies, or wish you had strategies on SPX? Well, of course, SPX options, SPX is available to search for in any strategy, with the exception of covered calls, because we can't buy the underlying index, which naturally also rules out collars, covered combinations, where you buy stock, sell a call, and sell out of the money put, and married puts, because we just can't own the index. Now, on PowerOptions, all indexes are preceded by a $sign. So if I was doing a search by symbol, looking at the chain, I'd enter $SPX, $NDX, $RUT for the Russell, and $VIX for the volatility index. So you can find positions in PowerOptions for SPX, $SPX, at any time. And in some strategies, there are defaults set up for you. For example, in the Iron Condor and I believe the Iron Butterfly, if you go into that sample searches field again instead of the main search, you'll have a selection there for index and ETF Iron Condors. We click on that list and it pulls up the results for us. And of course, one result per security, one of the other filters that you can use is selected. So we only have about 7 results, but you see here, there's Iron Condors on the Russell, SPY, QQQ, and the Ultra QQQ, TQQQ, DIA, and there's SPX, and there's IWM. And of course, it's important to remember that you can create your own search for SPX or any given stock in any strategy. Simply go into the search tool, scroll down below the listed trades to the parameter field, click on the Lists tab, and then click on the button for Create and Modify Stock Lists. This will show you your created list, your personal stock list, and you can simply click Create List, which will allow you to just input the symbols and create your own private stock or index list. So here I'll just name this SPX, and I could just put in $SPX. In this case, I'm also going to add $NDX and $RUT. Once I've entered in my field or pasted my symbols that I want, we'll click on Create. And now that list is available for me to select in the Stock List field under the Lists tab in any strategy search. So no matter what strategy I want to do, minus covered calls, married puts, collars, and covered combinations, of course, I can screen just against that list. But your main question comes down to what strategies are popular. Why don't you have just basic searches and teach an SPX strategy? Well, what strategies are popular? Well, due to the European-style expiration, where you can't be assigned early, and 3 days of weekly options, where every week you have a Monday, Wednesday, and Friday series, the most popular strategies I hear discussed for SPX are Iron Condors, where they're using those daily series, weekly series, or even a monthly series further out in time. Vertical spreads as well, mostly credits, bull put credit, bear call credit, although some debit spreads might be thrown in there as well. Again, depending on your preference, daily, weekly, or monthly. I've also had comments during the webinars, discussions during coaching session on near-term calendars. Now that these daily frequency options are available for Monday and Wednesday and Friday expirations for SPX and SPY, rather than an investor buying a call or buying a put that's 3, 4, or 5 months out in time and selling a month option against it, they're buying a call or a put that's 2 to 3 weeks out, maybe 1 month out, and selling the 2 to 5 days out against it to do sort of the diagonal spread or a calendar spread position. Of course, straddles and strangles are also popular. Not directly, but one of our regular attendees, Sam, mentions these from time to time on SPY. But at times what he's doing is when he's picked the market condition matching his trends, he might buy a call on SPY after it goes up. He might close that, or he might even sell a put with a long call, depending on his preference and the margin requirement. Another strategy that's popular, which is why I threw that up as the first image for this segment of the presentation, double diagonals, similar to iron condors, but with a calendar catch. Some refer to it as a near-term short strangle on SPX or SPY with a long-term strangle. What does that mean? Well, I might sell a near-term, 1 day out, just out of the money call and just out of the money put. Here you see with the SPX at 31.52, I might have sold a 31.30 put for July 10th expiration and sold a 31.70 call for the same expiration. Meanwhile, instead of the iron condor, where I'd also be buying a further out of the money put and a further out of the money call on SPX for the same expiration, I'm going further out in time to July 22nd, 12 days away, buying the out of the money 3200 call, buying the out of the money 3100 put. Now, as you can see, this is about $5,000 worth of debit into the position with still a promising return, but also the promise of lowering the cost basis of both of those long options with the near-term premium and trying to sell, again, those 2-day, 3-day out, maybe 5-day out options continuously against it for the next 12 days to get potentially the desired return. This does take on a heavy amount of risk, but not a lot. You can see here that the max risk at 77.50 is about 2 to 1, a little bit less than 2 to 1 to the cost basis, but the return, of course, is about 7 to 1 versus the risk, maybe 6 to 1 really mathematically, and that's okay. But it's just another strategy that's popular, trying to take advantage of these shorter term cycles that are available on SPX and SPY, the Monday, Wednesday, and Friday expiration, taking the general concept of a calendar spread or double diagonal and just shortening the time. Again, rather than buying 2 months out or 3 months out for the longs and selling 1 week out or 2 weeks out against it, maybe just buying the longs 12 to 15 days out, 2 to 3 weeks out, and trying to sell every 2 to 3 days against it with the Monday, Wednesday, and Friday available series. So you've heard me mention SPY in conjunction with SPX. What are the pros and cons of SPX over SPY? Well, SPX, the standard index, is a European-style expiration, which means you can't be assigned early. It's cash settled at expiration if you end up in the money, which can still be very expensive. But again, you don't have to worry about early assignment. Whereas on SPY is based on a fund where you can purchase the shares, so you can be assigned at any time. If you're doing a condor or you're doing a double diagonal or even a standard vertical credit spread, and the short put or the short call is in the money. SPX, I believe, still has a standard tax advantage. They're considered sort of as 1256 contracts. That's just a numerical number in the tax code, similar to what futures contracts are considering, so there's a slight tax advantage there. A pro of SPY over SPX is if you get in trouble on a specific spread, maybe a bear call spread or something along those lines, you can buy shares of SPY to work as a hedge of the position, just another extra management technique. You can't do that with SPX. Now, SPX has a 5-point strike difference because it's a higher price, naturally. It's 10 times the SPY. We're up at 3,100 in this case. So you have 5-point strike differences, and once we breach 3,400, it's a 10-point strike difference for all of the weeklies and for all expirations. The next available cycle is the 3410, then the 3420, and so forth. With SPY, you have a 1-point strike difference, which gives you a lower margin, and you're looking at a similar return with a similar probability. For a vertical spread, for example, a certain range out of the money, 10% out of the money on SPX or 10% out on SPY, I can use a 1-point strike difference for an iron condor, bull put credit spread, bear call. That gives me a lower margin. Now, in general, if I'm doing any strategy in my portfolio, either on SPX or SPY, whether it be bull puts or iron condors, I've already decided that I'm allocating X amount of funds, 10, 15, maybe 20%, probably 15 to 10% of my total portfolio to that type of vertical spread strategy. So whether it's a 10-point spread, do a bear call, for example. I sell the 3,400 and buy the 3,410, and I've decided to allocate $4,000. Well, that means I'd be doing 4 contracts. That's all I could afford to do with a 10-point spread. But the return and the credit I receive would be similar to doing 40 contracts on a 1-point spread on SPY. Of course, the SPX tracks the S&P 500 stocks directly as an underlying index that's an aggregate of all of the underlying stock prices at the close. SPY is almost exact, but there have been some instances where the price has lagged a little bit or maybe even exceeded depending on volatility. Because remember, it's a fund based on the SPX. So sometimes there's subtle differences at the end of closing that you might see. But again, they pretty much track 1-to-1, but sometimes you see subtle differences. It's just something to be aware of as well. All right, so after all of that, to faux traders' direct question, why don't we have SPX strategies? Well, as I mentioned, you can create your own SPX strategy in any of the strategy and the patented search tools we support on PowerOptions by creating that list, or just looking at the default index returns. Longer term investing, I haven't actually seen focusing just on SPX outperform using the same strategies across the broader market. In testing for strategies, I won't say the covered call picks of the day, weekly and monthly, because you can't do that with SPX naturally. But when Ernie did his testing on the naked puts picks of the day, and for those Bollinger Band searches we talked about while discussing the long options and % current option volume, and my research for the bull put credit spreads, the weekly bull put credit spreads, I did, and Ernie did, test our return results against what if we just did naked puts with similar criteria against SPX or SPY. What if I just did bull puts over this 3 or 4 year span on just SPX or SPY? And it turns out that our ending results for those testings and actual trading using just SPX or SPY didn't outperform what we were doing return-wise looking across the universe of optionable stocks, indexes, and ETFs. We've seen in those strategies better opportunities on the wider market. But all that being said, I do have many PowerOptions members who just trade spreads, longs, buying calls, buying puts, and straddles on SPX and SPY with a portion of their portfolio. We recently just made an adjustment to the portfolio tools themselves in PowerOptions to show the analysis over time, not only by symbol, which was the default, but also by what's called position ID, or by position. So an investor who asked us for this sort of different way to view the portfolio, he trades many spreads on SPX for the Monday, Wednesday, and Friday expiration, but he didn't want them all lumped in together to track a total return on SPX. He wanted to look at each individual position and the gain and loss to help him with his notes and develop his trading plan. So we actually made this change in the portfolio for him. So I do have investors that do that just on SPX, but not with their whole portfolio. And I'm pretty sure, that's not what you were asking, but as a portion of their portfolio. And on that note, we recently had a comment from a YouTube member, EricJ, that came in 2 days ago from one of our recent presentations. He had commented on the SPY, but he also said, I usually do the following. Buy 100 shares of SPY, which again we can't do with SPX. You might be able to do a synthetic in this case, but he's buying 100 shares of SPY outright. Buying a long-term put, buying a put that's at the money that's 2 months out in time. And then selling a call 1 or 2 points above the at the money or the current cost that's equal expiration 2 months out in time. So that's a standard collar, but it's sort of an out of the money collar where the put's at the money instead of out of the money, and the call is further out of the money than at the money. But that's okay. It's a debit collar most likely. But to compensate for that, EricJ then sells a put with a delta of 20 or less 2 months out to take in another credit. Now, so far, this has worked out best for him. Worst case scenario, get assigned on the short put, and now they own more shares of stock. And they'll have to readjust this long put and the short call as part of the collar, and then maybe sell another put that's out of the money. Best case scenario, naturally, this is still a bullish position. The stock would move above the short call strike, get assigned for the return, and the protection is in place there with the put. Well, the protection's only there for either the 100 shares of stock or the naked put, not for both. There's still a risk to the downside. Now, terminology-wise, we can look at this as a long collar with a naked put, as I mentioned, or that covered combination we mentioned earlier with buying shares, selling a call, and selling a put. But we might call this a married covered combination because you're adding the put into it to hedge some of the risk on the long shares of stock or on the naked put, but not on both. I know many of you out there probably have your own strategy, and I'd love to hear it. Let me know your SPX strategy. Tell me in the comment section of the YouTube video how you like to approach trading SPX or SPY, or you can send me an email individually to support@powerop.com, and I'll eventually share that with FoTrader as well. Well, I hope you enjoyed this little presentation on using unusual options volume with the PowerOptions tools, strategies that might work for, and a discussion on how to potentially use SPX in your portfolio, strategies that may be incorporated, and why you might not just want to devote 100% of your portfolio to just trading SPY or SPX in a given strategy, because we've seen other more positive returns using the proper criteria in given strategies, but looking across the universe of options for a little bit more volatility and a little bit more oomph. Don't get me wrong. It's great for new traders and new investors to focus just maybe on a stock that they know, or to focus on SPX or SPY, because in general there's less volatility in those positions than there is across the broad market. But if your targets are high, your expected return for options investing in your portfolio over a 1-year period is maybe above 25%, over 20% perhaps as well, you may want to consider just using some SPX and SPY strategies as a portion of your portfolio, because you might not hit that desired return mark with your options positions using just those two underlying symbols. We'll see you on the next requested topic seminar coming up soon.